What is the first step in admission of a partner? We work out which one? New profit sharing ratio. Wait. How to work out new profit sharing ratio? We had seen different cases. Old ratio will be given, new ratio will be given, or sacrifice will be given. Based on that, we work out. Goodwill, we have seen three methods. What are the three methods? Revaluation, where goodwill accounted out to old partners and old ratio. Since there is no cost, if it is written off, what is entry will pass? All partners capital accounted out to goodwill. Then we had seen premium method. What is a premium method? When new partner brings in cash for goodwill, what is entry will pass? Cash accounted out to goodwill, that will be transferred to old partners in which ratio? Sacrificing ratio. If it is adjusted through capital account, just new partners capital accounted out to what? Old partners capital account. Difference between B and C is, in case of B, the new partner brings in cash. The new partner brings in cash. In case of C, new partner is not bringing in cash. We have done an example also, right? AB old ratio 3:2. This is where we stopped in the last class, I hope, right? New ratio of ABC 2:2:1. Goodwill was valued at 5 lakhs. Sacrificing ratios, old ratio minus new ratio. A sacrifices. A sacrifices how much? 1/5. B was not sacrificing. So under revaluation method, what is entry we pass? Goodwill accounted out to old partners capital and old ratio. If the goodwill is written off, what is entry? All partners capital accounted out to goodwill in which ratio? New ratio we have seen. Premium method. Suppose if C brings 1 lakh for goodwill, not 5 lakhs. 5 lakhs is the total goodwill of the firm. But the new partner will bring 5 lakhs? No. His share he will bring 1 lakh. That will be transferred to sacrificing partner. Last class we had seen there are two partners. Which partner sacrificed? Partner A sacrificed. So 1/5 that is transferred to what? A's capital. If it is adjusted through capital, just new partner's capital to what? Old partner's capital. Why? Because new partner is not ready to bring cash, or he is not having cash to bring in for goodwill. So these are the three methods we had done in the last class, or we had seen in the last class. The same thing we have done and we stopped. So when a new partner is admitted, what is the first thing you have to do? New ratio. Then adjustment for which one? Goodwill. Imagine, paying attention. Let's assume you three people are doing business. A, B, C are doing business. You are taking me into the partnership. You are taking me into the partnership. Okay, you purchased your land, building, plant and all about 5-6 years back. Today, will they have same value or different value? So you will revalue. Who will revalue? Old partners will revalue. Old partners will revalue. So step 3, start. Everybody, start step 3, revaluation account. Preparation of revaluation account. Theory area. Theory. Revaluation account. Look at the word. Is it realization account or revaluation account? Revaluation account. Just to record profits and losses. Just to record which one? Profits and losses. It is a nominal account. Listen, it's a nominal account that we are going to prepare. Just to record profits and losses, we are going to do this. Start. Have the heading. Ledger account heading. Revaluation account. Tell me which one is a gain, which one is a loss. Change in asset value, when it will become a gain, when it will become a loss. Increase in asset is a gain for us. Decrease in asset is a loss for us. Credit side, start by increase in assets. It can be any asset. It's a gain for us, we record. Debit side, to decrease in assets or reduction in assets. It can be bad debts, provision for bad debts or depreciation, anything. Decrease in asset is a loss for us. Gain, you credit all gains, debit all losses. Then, by decrease in liabilities, some discounts we may expect, or reduction in liability we may expect. So, decrease in liability is a gain for us. When a liability goes down because of discounts, then it is a gain or loss. It's a gain. You will credit. To increase in liabilities. For example, some bonus claim was under dispute that is becoming payable now. Bonus was under dispute, we recorded 0. Some 5 lakhs is payable now. When a liability becomes payable, which is not recorded, is it a gain or loss? Liability was not recorded in books, it becomes payable now. Is it a gain or loss? Loss. Or sometimes you would have provided for tax 5 lakhs, but income tax department may disallow certain items and finally may claim more amount. We provided only 5 lakhs, but demand from income tax department is 8 lakhs. You have to pay more. That's a gain or loss? Loss. So increase in liability is a loss. Credit the gains, debit the losses, and the profit. If there is a profit, it will be transferred to whom? Old partners in old ratio. The gain or loss will be transferred to old partners in which ratio? Old ratio. This is step 3. Nothing much to learn in this. Just credit the gains and debit the losses. Transfer the net profit to whom? Old partners to old ratio. Why? Because this revaluation happened in the past or change happened in the past. If there is a loss also, we will transfer the loss. That I did not want to tell it. It is automatically understandable. By loss also, it will be transferred to whom? If there is a loss, it will be transferred to old partners in old ratio. That you need not write. That is automatically understandable. Clear? That is step 3. What is step 3? Revaluation account is done. Next, step 4. Step 4. We will prepare capital account. We will prepare which account? Capital account to adjust all these things. Capital account is prepared to adjust all these things. By balance brought down. By balance brought down is nothing but opening capital. Then, by cash account or bank account. Simple. Capital brought in by the partner. Okay. What is the journal entry for cash brought in for capital? Cash account data to capital account or bank account data to capital account. By bank account, capital brought in. Then, what is the journal entry we pass for raising the goodwill? Goodwill account data to old partners capital account. How this will be posted in capital? By goodwill. Goodwill raised. Then, what is the next entry we used to pass? Goodwill is written off. All partners capital account it out to goodwill. To goodwill, written off. Please take it along with me, no need to wait. Then, if there is a revaluation profit, what is the entry we pass? Revaluation account data to whom? Old partners capital account in which ratio? Old ratio. Take it up. Revaluation account profit. It will be transferred in old profit sharing ratio to old partners. This account will be prepared in columnar format. If there are 3 partners, debit side particulars 3 columns, credit side particulars 3 columns mark. By revaluation account, old profit sharing ratio you will transfer. Then, by general reserve or profit and loss account balances. For example, in the balance sheet, you can find some general reserve P&L account accumulated by old partners. In the past, they created general reserve, they created P&L account, undistributed balances are there. That belongs to whom? Old partners or all partners? Old partners. It will be transferred in old profit sharing ratio. In the old balance sheet, if you find any general reserve or P&L account, that will be transferred to old partners in which ratio? Old profit sharing ratio. Next. To wait, like profit they share, losses also they should share. Miscellaneous expenses like advertisement, suspense, preliminary expenses. Losses also will be transferred to which partners? Old partners in old profit sharing ratio. If there is a loss, we will transfer the losses to old partners. Losses may be in the form of advertisement expenses not written off, preliminary expenses. Those are transferred to old partners in which ratio? Old profit sharing ratio. Then you will work out to balance carried down. To balance carried down is nothing but which balance? Closing balance. Once again, repeat, please listen. Capital account, by balance brought on is nothing but opening capital. By bank account is nothing but the capital brought in. Goodwill raised is credited to the partners and written off is debited to the partners. Revaluation account profit is shared. Any old general reserve P&L account is shared. Losses are written off amongst partners because past losses who should bear? Old partners will bear, then balance carried down. Suppose if there is a revaluation loss, what would have happened? Instead of by revaluation profit, it would have happened as to revaluation loss, like that you would have done. This is step 4. Step 4, prepare which account? Capital account. And the last step is prepare balance sheet. Prepare balance sheet with old asset value or new asset value? New assets and liabilities, capital. Prepare the balance sheet with new assets, liabilities, and which one? Capital. Once again, what was the first step? New ratio, old ratio, difference will be sacrificing ratio. Second, you adjust for goodwill. And third, you prepare which account? Revaluation account. And of course, prepare the capital account. Just simply to understand, old opening balances are there. New partner brings in capital, share of goodwill, share of revaluation profit. The old profits are distributed to old partners. If goodwill is written off and losses are written off, it is debited. Then you get what? Closing balance that will appear in the new balance sheet. Then prepare which one? Balance sheet with new assets, liabilities, and which one? Capital. These are the 5 steps you will apply in any exam question. Okay, there are certain additional notes. I will come back to it. Okay, take your material. Admission of partner. Go to question number 1. Read the question, understand the question, only then we can solve it. Who are the partners? Straight away, it is an examination problem for 15 marks. They test from minimum 10 marks to 15 marks. First question was tested for 15 marks in the past. Who are the partners? L, R, N are the partners. Sharing profits and losses in which ratio? 2:2:1. Old ratio is 2:2:1. Old creditors, outstanding liabilities, then general reserves are given, capital account is given. Land and building, furniture, stock, debtors, cash in hand, cash at bank is given. This is old balance sheet or new balance sheet? Old balance sheet. This is old balance sheet. Then the partners have agreed that, what the partners have agreed? The partners have agreed that S will be taken as a partner from 1st April 2014. S will be taken as a partner from 1st April 2014. Look at this. S brings the following asset into capital. S brings the following asset into capital. What are the assets brought in by the partner? Stock, machine, cash. New partner is not bringing one asset into capital. What are the 3 assets brought in? Stock, machine, and capital. Wait. This is point number A. New partner's capital. Look at point number B. Value of stock should be increased by, okay, increasing the stock value, is it a profit or loss? So point number B is about revaluation account. Point number C, provision for bad debts. Creating a provision for bad debts, is it a gain or loss? Loss. Furniture to be depreciated by 10%, gain or loss? Loss. Then they have given the value of goodwill, how much? 15,000. Then general reserve will be distributed to old partners, of course, in the old ratio. Then value of land and building to be enhanced by, what do you mean by enhanced? Increased by 20%. Is it a gain or loss? Gain. New profit sharing ratio is given in the question. 5:5:3:2. Look at point number E and point number I. Point number E, they say that goodwill is 15,000. Goodwill is 15,000. Look at point number I. What do they specify? Goodwill should be written off amongst partners account in accordance with which ratio? New ratio. Now, 3 methods of goodwill we learned in the last class, right? What are the 3 methods? Goodwill raised, then written off. New partner brings in cash for goodwill. adjusting through capital account. Three methods we learned. In this question, which method you will follow? Value of goodwill is given as 15,000. Then subsequently they say the goodwill should be written off to partners' capital in new ratio. Raise the goodwill how much? 15,000. Write off the goodwill in new ratio. Raise the goodwill in old ratio. Write off the goodwill in which ratio? New ratio. Okay, raise the goodwill in old ratio, write off it new ratio. Then point number J paranga. What is point number J? Outstanding liability include 1,000 due to A which has been paid by L. Necessary entries is not made in the books. It's an error. We have to rectify. It's an error we have to rectify. Some 1,000 rupees is payable to A that has been paid, which is not accounted in books like that. It is given to us. We have to rectify the error. Shall we? Start. What is step 1? Please start along with me, do it along with me so that you will understand better. Who are the partners, old partners? L or N. Who is the new partner? Yes. What is the old ratio that is given in the first line of the question? Old ratio is given in the first line of the question itself. 2:2:1. 2:2:1 ratio. Old ratio is like 2:2:1. What is the new ratio? That is given in the adjustment. Directly given in the adjustment. What is the ratio? 5:5:3:2 ratio. 5:5:3:2 ratio. 5:5:3:2 ratio. Old ratio, new ratio. Whether you have to work out sacrificing ratio in this question? Whether we have to work out sacrificing ratio in this question? No errors. Wait, goodwill, under which method we are going to adjust? Goodwill, we are going to follow revaluation method. Raise the goodwill in old ratio. Raise the goodwill in old ratio. Write off the goodwill in which ratio? You require a sacrificing ratio. No, why to work out unnecessarily? Sacrificing ratio is required only when you follow premium method. Here there is no premium method. Just old ratio and new ratio, that's all. Old ratio, new ratio, step 1 over. No need of sacrificing ratio. Start. Step 2. Step 2, adjustment for goodwill. We are going to follow which method? Revaluation method. Start. Step 2, goodwill, revaluation method. What is the first entry we will pass? What is the first entry we will pass? Goodwill account data to old partners. Who are the old partners? L's capital account to R's capital account. To which account? N's capital account. This will be transferred in old ratio. What is old ratio? 2:2:1 ratio. You will raise the goodwill in old ratio. You will raise the goodwill in old ratio. What is the goodwill value? 15,000. Transfer it in 2:2:1 ratio. 6,000. 6,000 and what? 3,000. Goodwill account data are to old partners capital account in which ratio? Old ratio. Then it is given point number J. Goodwill should be written off to partners in accordance with which ratio? New ratio. So what is the entry you have to pass? All partners capital account data, L's capital account data, then R's capital account data, then N's capital account data, S's capital account data, to whom? To goodwill account. This will be in new ratio. What is the new ratio? 5:5:3:2. This will be transferred in new ratio. What is the new ratio? 5:3:2 ratio. 5:5:3:2 ratio. Transfer it. 5,000, 5,000, 3,000, 2,000. Goodwill is adjusted using which method? Revaluation method. Raise the goodwill to old partners and write off the goodwill to what? All partners. It is not new. Already we learned in the last class. We are just applying it. Revaluation method. Old goodwill go to old partners and the goodwill written off is written off amongst all partners. Otherwise, this journal entry is passed before admission of a partner. First journal entry is passed before admission of a partner. This journal entry is passed after admission of a partner to write off the goodwill. So we followed which method? Revaluation method for goodwill. Start. Step 3. What is step 3? Okay, in the middle of the heading, revaluation account. Revaluation account. We have to record which one? Credit side, what we should record? Gains or profits. You have to record in the credit side. Debit side, what you should record? Losses you have to record. Gains and losses you have to record. I told you already, what is a gain? What is a gain? Increase in asset is a gain. Reduction in liability is a loss. Now, this will be prepared based on whatever I circled, like point number B, value of stock, point number C, provision for doubtful debts, point number D, furniture value, then point number G. Point number B, C, D, G talks about which one? Change in the value of assets and liabilities. If you record the gains and losses, record the gains and losses. Pay attention. First entry, point number B. What is given in point number B? Stock should be increased by, so by stock account. It's a gain for us 2,500. Then listen to it for about 5 minutes and you can copy. Listen. What is the next one? Point number C. Provision for bad debts 10% on debtors. Creating a bad debt, is it a gain or loss? Loss. So to provision for bad debts. To provision for bad debts, 10% loss. How much? 550. Then, what is the next one given? Furniture to be depreciated by 10%. Depreciation on furniture is a gain or loss? Loss. 10% furniture value 6,500, 10% quota 650. Then, what is the next one? Land and building should be enhanced by 20%. Enhanced means increased by 20%. By land and building 20%. Look at the land and building value 25,000, let 20% quota 5,000. Any other adjustment regarding revaluation? Once again, point number A talks about assets brought in by the partner. That is not revaluation. Point number B, yes. C, D, yes. Point number C is about, E is about which one? Goodwill. Already we adjusted. General reserve will be transferred to partners capital account. That will be coming in capital account of partners. Point number G adjusted. New profit sharing ratio over. Goodwill we have written off. Look at point number J. Is it revaluation? Outstanding liability include 1,000 due to Mr. A, which has been paid by L. Accounts is not adjusted for this. Wait. Is it a change in asset value? No. Decrease all, increase all. Look at the adjustment. Outstanding liability is paid or not paid? Simple. What is the entry for payment of liability? What is the entry for payment of liability? Liability accounted to cash. Now this liability is paid by a partner. This liability is paid by a partner that is not recorded in books. Liability accounted to capital account. Wait, if firm is paying, pay attention. If firm is paying, what is the entry we would have passed? Liability account debtor to cash account, like that you would have passed. If the partnership firm is paying money, here who paid this money? Partner. It has to be adjusted in capital account. It has to be adjusted in which account? Now, is there a revaluation? No. An entry is omitted. An entry is omitted which we have to rectify. That is not revaluation. That's all. You can tally this. You will get which one? Profit that will be transferred to whom? L or N. In which ratio? Old ratio. What is old ratio? 2:2:1 ratio. So whatever is the profit that will be transferred in old ratio. 6,300 will be there. That will be transferred to old partners in which ratio? Old ratio. 2:2:1 transfer panel. The profit will be transferred in old ratio. 2:2:1 transfer panel. 6,300 into 2 by 5. 2 by 5, 2 by 5, 1 by 5. So revaluation account is prepared just to record which one? Gains and losses. I repeat the steps once again, pay attention. Goodwill by revaluation method, raise the goodwill to old partners in which ratio? Old ratio. Write off to all partners in which ratio? Now, I told you the logic already. Listen, goodwill is raised because it was earned by the old partners. In which ratio? Old ratio. Since there is no cost for the goodwill, is it a purchased goodwill or self-generated goodwill? Self-generated goodwill, goodwill earned by the firm. It has to be written off amongst all partners in which ratio? New ratio after the admission. So they do it. Revaluation account, just record gains and losses. Stock appreciating, land and building appreciating, it is a gain for you. Providing a bad debt or reduction in furniture value is a loss for us. The net profit is transferred to old partners in which ratio? Old ratio. That is step 3. Start next, step 4. Step 4, which account you have to prepare? Partners capital account or capital account of partners. You can do it or just keep the title capital account. Wait, you should have particulars and 4 columns each side. 4 partners, particulars L, R, N, S. Start. Particulars, how many columns? 4 columns on each side. Have it, then we will start. Any doubt in revaluation account? Listen, any doubt in revaluation account? Stock, land and building appreciating, other assets are reducing, you get the profit or loss. Clear? Pay attention. Pay 100% attention here. Okay, if you chat amongst yourself, please go outside and chat and come back. No need of being in the class. Okay, listen, 100% listen because it's the first problem we are doing. Capital account of partners, LRNS. Now listen to it, then you can copy it later. By balance brought down. By balance brought down, LRNS. What is opening balance? 12,000, 12,000, 5,000. 12,000, 12,000 and what? 5,000. Look at the new partner. Is he just bringing in cash? First adjustment partner. Is he bringing in cash? No. He brings in what? Stock, machine, cash. So it will come as by stock account. New partner S brings in. What is it? 1,000. By machinery account. He brings in how much? 2,500. By cash. 1,500. See, while giving the format, I've just given us new partner brings in cash by bank account. Here he is not bringing one amount, one particular asset. He is bringing what? Multiple assets. That's why by stock, machine, cash brought in by which partner? New partner. Then goodwill. How did we adjust goodwill? Goodwill account data to LRN. How this will be posted? By goodwill. By goodwill. How much amount? 6,000, 6,000, 3,000. Old partners credited to goodwill. To goodwill account. Second entry part. In entry pass pannu. LRNS to goodwill. Written out. LRNS to goodwill. How much? 5,000, 5,000, 3,000, 2,000. Then revaluation account. Revaluation account la paranga. Is it a profit or loss? Profit. Transfer to old partners. Transfer to old partners. How this will come? By revaluation account. By revaluation account profit. Transferred amongst old partners. It is transferred amongst old partners. In a ratio, 2:2:1 ratio. We already worked out 2520, 2520, 1260. Then, very important thing. So far, okay. Thereafter, pay attention. Look at the old balance sheet. If you find any old reserves or P&L account balances, this general reserve belongs to which partners? Earned or accumulated in the past, it belongs to old partners. It will be transferred in old ratio by general reserve. Old ratio. What is old ratio? 2:2:1 ratio. What is the general reserve given? 6,500. Old ratio will transfer panna. 6,500 into 2 by 5, 2 by 5, 1 by 5. How much? 2,600, 2,600 and what? 1,300. See, once again, from this you should understand old capital, old goodwill, past revaluation profit, old general resource belong to which partner? Old partner. Whatever the capital brought in by new partner only belongs to which partner? New partner. In this question, goodwill is written off. Pay attention. Any profit and loss account? Any profit and loss account you find in the old balance sheet? Check the asset side also. Do you find any losses like preliminary expenses, advertisement suspense, P&L account debit balances? Any losses are there? No losses are there. That's all. You can tally this. You will get closing balance. To balance carried down. So capital account is to record all your past adjustments, revaluation adjustments, goodwill adjustments, all those things, and you can close. This capital will come in the balance sheet. Very good. Point number J. Outstanding liability include 1,000 due to Mr. A, which has been paid by what? L. Wait. We had seen already a journal entry. What is a journal entry when the liability is paid? Outstanding liability account data or to cash you would have put. But in this question, are we paying cash or a partner is paying? So L's capital account. Credit the giver. Debit the receiver. Credit the giver. L is giving. So how much is given by L? 1,000. How this will be posted in L's capital? How this will be posted in L's capital? This will be coming as by outstanding liability. How much is paid? 1,000 rupees paid by L. That's it. Tally this. You will get which one? Closing balance. Take up this now. Take up capital up. Right? Prepare a balance sheet also. Balance sheet. Yes. Next, liability side, let us maintain the same order of the old balance sheet so that we will get proper balances also. Let us maintain the same order so that you will not miss anything. What is the next? What is the first one? There is no order. You can prepare capital first or write capital first, other liabilities next. There is no order. Sundry creditors. Any change in creditors balance? No. What is the amount? Then outstanding liability. So the same amount will come. Outstanding liability. How much is given in the old balance sheet? 1,500 paid by L 1,000. So how much will come? 500. Then what else? Capital account of partners. Capital account of which partner? L or NS. The closing balances. 19,120, 18,120, this 7,560 and 3,000. Capital account of partners will come. Any other liability? Any other liability? No. Asset side, let us maintain the same order. Whether goodwill will come in the balance sheet? No, it is written off. Goodwill is written off. It will not come in the balance sheet. Then, what are the other assets? Land and building, how much is given? 25,000 plus appreciation 20%. Plus appreciation 25% add panna 30,000. Then, what is the next one? Furniture 5,500 minus 10%. 6,500 minus 10%. How much? 5850. 5850. Next. What is the next one? Stock. Listen, already old balance, how much is there? 7,000? 11,000? 750. Plus, wait. New partner brought. Yes, how much he brought? Look at point number 1. Stock 1,000 brought in. Then, plus increase in stock. 11,750 is old balance. Yes, brought at the time of admission of a partner, he brought how much? 1,000. Increase in asset value, how much? 2,500. Include all these things, you will get the total. Old balance of stock plus stock brought in by S plus increase in asset value. What is the total? 15,250. That is the stock value. Then, what is the next one? Datas. Any change in datas balance? Less provision. How much percentage created? 10%. So 5,500 minus 10%. 4,950. Then, before that, there is one more thing. Machinery brought in by the partner. There is no old machinery. Machinery brought in by us. By new partner. New partner brought in machinery. How much? 2,500. Do not ignore that. Okay. Stock brought in by us, already added with stock. Machinery brought in by us, added to machinery. Then, cash in hand, 140. 140 plus, yes, brought in how much? So 1650. Bank balance, that will continue. There is no change in the bank balance. How much? 960. Why there is a difference? Yes. Before we go to the next question, we have to learn something more, then we have to proceed. Have a heading, a new heading. See, we already learned this under premium method how to adjust goodwill. When will you follow premium method? When will you follow premium method? When the new partner brings in what? Cash for goodwill. When the new partner brings in cash for goodwill, what is the entry we'll pass? Cash upon debtor to new partner's capital. New partner's capital to old partner's capital in which ratio? Sacrificing ratio. Have an additional note there. Have an additional note in the theory. Start. When? Next. Premium method. Pay attention. What is the entry we pass? Why new partner brings in cash? Think logically. You are paying capital and joining the firm. You should pay money for our goodwill also. You should pay money for goodwill also. That is why it is called as premium for goodwill. That is why it is called as which one? See, we have run the business for the past 10-15 years. Just like that, you join, contribute capital, enjoy the profit. No. For our goodwill also, you have to pay money. That is the approach behind this. Clear? So, new partner brings in what? Cash for goodwill. Then that is adjusted in which ratio? Sacrificing ratio. Now, what about if there is an old goodwill in the balance sheet? In this case, if there is any old goodwill in the balance sheet, don't copy this, pay attention. Look at this. There is a goodwill in balance sheet. What is a goodwill in balance sheet? 4980. Manisha is admitted for the partnership. Her goodwill is calculated at 12,000. Is it total goodwill or her goodwill? Her goodwill means she has to bring in money for this. She has to bring in money for goodwill. How much she has to bring in? 12,000. She brings in money for goodwill. What about this old goodwill then? Partners cannot get double benefit. Old goodwill also will continue. New partner also will bring in cash that we will share. Like that, you cannot enjoy what? Double benefit. So what happens is, if old goodwill is there in the balance sheet in this situation, that will be written off. It will be written off to old partners in old ratio. Please note this. Clear? When premium method is followed, if old goodwill is there in the balance sheet, it will be written off to old partners in which ratio? Old ratio. Start. When premium method is followed, old goodwill in the balance sheet will be written off to old partners in old ratio. No need to copy this. Already we have taken that in the last class. When premium method is followed for goodwill, then old goodwill is written off to old partners in which ratio? Old ratio. Now read the second question. We'll be able to solve. The reason is old partners cannot have two benefits. I will record goodwill as well as I will get cash. Now you are getting double amount. That's why old goodwill will be written off to old partners in which ratio? Old ratio. Now go to question number 2. It's a very good question that can be tested for 15 marks in the exam. Go to question number 2. Who are the partners? Ranu and Mill are partners in a firm sharing profits and losses in old ratio 2:1. Old ratio 2:1. Balance sheet is given on 31st December 2013. Creditors, there is an investment provision. There is an investment provision. What do you mean by investment provision? If there is a loss in investment, that will be adjusted with investment provision. If you create an investment provision, if there is a loss, it will be adjusted against what? That investment provision. Then general reserve is given, workman compensation fund is given, capital of Ranu and Mill is given to us, investment, stock, goodwill, debtors minus provision, bills receivable, bank balance are given. Look at this. On the above date, who's admitted? Manisha is admitted for 2/5 share of profit. Old share is 2:1. Old share is 2:1. New share of the new partner only is given. 2/5. The following adjustments are made. New partner will bring 15,000 as capital. 50,000 as which one? Capital. Her goodwill is calculated at 12,000 means she has to bring in this goodwill. Please note here premium method. You are admitted as a partner in the firm. Your goodwill is 12,000 means you bring money for that. How much you have to bring? 12,000. Then Ron and Millie has purchased a machinery on hire purchase system for 15,000. How much to be paid? Only 500 are to be paid. Look at the next sentence. Both machinery and unpaid liability did not appear in the balance sheet. We have not shown this machinery in the balance sheet. How much to be paid? Both are not shown in the balance sheet. Revaluation. We have to adjust in revaluation account. Then there was a joint life policy for Ron and Millie for how much? 7,500. Surrender value is how much? 12,000. Okay. Now we have to learn another new point over here before we continue. Are they getting? Joint life policy. Joint life policy. Sir, what do you mean by joint life policy? This is nothing but insurance policy. Insurance policy taken on life of partners. Taken on life of partners. So joint life policy is nothing but insurance policy taken on the life of partners. Joint life policy, insurance policy taken on which one? Life of partners. But who will pay the premium? Partners will pay the premium or firm will pay the premium? Firm will pay the insurance premium. So, it is whose investment? Partners' investment or firm's investment? It is firm's investment. JLP is the firm's investment. Firm's investment means firm is investing on the life of the partners. Firm is taking the insurance policy. Partnership firm da invest pannirukanga. They are paying the premium. Joint life policy is the firm's investment. So insurance policy taken on the life of the partner, firm will pay the insurance premium. So it is an investment of the firm. It is an investment of the firm. Wait for it. Let's assume ABC insured for 10 crore. Insured for 10 crore. Suppose if anyone dies, who will get this 10 crore? ABC will get 10 crore or firm will get 10 crore? Who made the investment? Firm has made the investment. If anyone dies, what will happen? Firm will get 10 crore. Firm will get 10 crore that will be distributed amongst partners. Now, are we in admission of partner or death of a partner? After admission of partner. See, okay, take up this. On the death of a partner, firm gets policy value. On the death of a partner, the firm will get which value? Full policy value. What about in other situations? Which may be admission of a partner or retirement of a partner, change in profit sharing ratio, splitting the firm, amalgamation of firm. What about in other situations? Will he get full value? Policy is taken for 10 crores. When will he get policy value? Only when a partner dies. Now, there is no death of a partner. It is only admission of a partner. Then what the firm will get? Simple. Listen, you have taken insurance policy. Everybody paying attention. You have taken an insurance policy for 20 years. You paid premium for about 10 years. At the 10th year, you are going and telling, I don't have salary, I don't have income, I cannot pay premium. I cannot pay premium for next 10 years. Total term is 20 years. I paid for 10 years. Now, you are going and telling that I cannot pay premium because I don't have income to pay the premium. I want to surrender my policy. Then what will you get? You will get surrender value. The firm will get which value? Surrender value. So how much will be the surrender value? Depends on the insurance norms. Depends on which one norms? Insurance norms. It will be 20% of policy, 30% of policy, 40% of policy, depending upon the terms of agreement. While taking the insurance policy, they would have given If you wait for 20 years or if you die, you will get full policy value. Okay, if you surrender in 3 years, nothing will be paid. If you surrender in 5 years, you will getting 20%. If you surrender in 10th year, you will get 50% like that. It will be there in which document? Policy document. So for us to understand, only on death of the partner, the firm will get which value? Policy value. In other situation, the firm will get only which value? Surrender value. Note this. In other situation, the firm will get surrender value. So at the time of admission or retirement or death of a partner, what to do? We'll adjust for, adjustment is done for which value? Surrender value. Adjustment is done only for the surrender value. Sorry, admission or retirement of a partner. Admission or which one? Retirement of a partner. Adjustment is done only for which value? Surrender value. Take up this, then we'll proceed. So it's an insurance policy taken on life of partners. Investment is done by the firm. Premium is paid by the firm. On the death of the partner, the firm will get policy value. In any other situation, the firm will get only which value? Surrender value. Admission or retirement of a partner. Adjustment is done. Adjustment is done for which value? Surrender value. Adjustment is done for surrender value. Now come back to the question. Point number D formula. There was a joint life policy on the lives of Ranu and Billy for 75,000. Will you get policy value? No, policy value will not get. Then surrender value of the policy is how much? The surrender value will be adjusted. Surrender value will be adjusted. Accrued income not appearing in the books is 500. Market value of investment is how much? 23,900. Shika, an old customer, promised to pay how much? 1,750. Claim on account of compensation estimated at 750. Provision for doubtful debts required is how much? 3,000. So this point number I, or adjustment of liability, or old customer now coming and promising to pay the money, or the accrued income or market value of investments, all these are connected with revaluation. All these are connected with what? Change in assets and liability value. Joint life policy we have to adjust separately. Then point number C also. Adjustment for mission or liability is what? Revaluation. Goodwill we will do it separately. Then Manisha will bring what? 50,000 as capital. Shall we start? Step 1. What is step 1? New ratio. And in this question, do we require sacrificing ratio? Yes. Why? Goodwill, we are going to adjust in which method? Premium method. So cash account data to new partner capital to old partner capital in which ratio? Sacrificing ratio we have to adjust. We require a sacrificing ratio. New ratio இதே மாடல்ல பண்ணிருக்கோமே problems. Last classல பண்ணோம் இல்லையா new ratio. Wait பண்ணுங்க. What is the old ratio of Ranu and Millie? 2/3 is to what? 1/3. What is the new ratio of Manisha? 2/5. Ratio of Manisha is given 2/5. Others ratio is not given. What to do? Do you remember? If Manisha takes 2/5, balance will be they mari பண்ணிருக்கோமே 2/5 goes to Manisha, and balance will be 3/5. This 3/5 will be shared by whom? Old partners. This 3/5 will be shared by old partners. So Ranu will share on the 3/5 le 2/3. 3/5 into 2/3, how much you get? 3/5 into 2/3, 6/15. 6/15. 2 into 3, 6, 5 into 3, 15. Milli. How much? 3 by 5 into 1 by 3, she will get how much? 3 by 15. Okay, for Manisha, 2 by 5 can be written as 2 by 5 can be written as 15 க்கு போட்டா 3 times multiply பண்ணி how much? 6 by 15. So new ratios 6 is to 3 is to 6. Take up this. Ranu. 6 is to take up this. 6 is to 3 is to 6. This can be written as 6 is to 3 is to 6 can be written as so 2 is to 1 is to 2. So this is the new ratio. 2 is to 1 is to 2. We want sacrificing ratio. How to work out sacrificing ratio? Old ratio minus what? New ratio. What is the old ratio of Ranu? 2 by 3 minus new ratio 2 is to 1 is to 2. 2 is to 1 is to 2. 2 by 5, 1 by 5, 2 by 5. 2 by 5. 2 by 3 minus 2 by 5. LCM எடுத்து போட்டா 15 வரும். 5 into 2, 10 minus 6. Ten minus 6 by 15. How much it will be? 4 by 15. For Mini, it is 1 by 3, 1 by 3 minus Milli, 1 by 5. 1 by 3 minus 1 by 5 will be 2 by 50 now. So sacrificing ratios 4 is to 2. 4 is to 2 can be written as 2 is to 1. So we worked out sacrificing ratio also. Any doubt in it? This model already we have done in the basics class, where old ratio is 2 is to 1. New ratio is given for the new partner. If new partner takes 2 by 5, balance will be what? 3 by 5, that is shared by the old partners. Then Manisha, 2 by 5 can be written as what? 6 by 15. 6 is to 3 is to 6 can be reduced to 2. 2 is to 1 is to 2. So old ratio minus new ratio will give us which ratio? sacrificing ratio. 4 by 15, 2 by 15 can be written as what? 2 is to 1. You can verify your answer also. For example, Manisha, what is the ratio we written? 6 by 15. If you add up the sacrificing ratio, it will come to new ratio. 4 by 15 sacrificed by Ranu. Millie sacrificed how much? 2 by 15. And add 4 by 15, 2 by 15, it will come to 6 by 15. Always sacrifice will be equal to what? Gain by the other partner. Or other. Start. Step 2. What is step 2? Adjustment for goodwill. Adjustment for goodwill. Premium method. Premium method we follow because cash brought in by new partner. Cash is brought in by new partner, so we are going to follow premium method. What is the entry for cash brought in by the new partner? Cash account debtor. How much new partner brings in? 12,000 to Manisha's capital. 12,000. And this will be transferred. Manisha's capital account debtor. This will be transferred to whom? Old partners in the old ratio. Very good. Sacrificing ratio. To which capital? Ranu's capital to Millie's capital. In sacrificing ratio. That is also 2 is to 1. In this question, sacrificing ratio and old ratio are the same. But to mark it as sacrificing ratio, because when you read it later on, you may get confused that old ratio was sacrificing ratio on. But to note it as which ratio? Sacrificing ratio. Cash account debtor to Manisha's capital in which ratio? That is 12,000, okay. Manisha's capital to old partners in which ratio? Sacrificing ratio. It is not over. Look at the old goodwill. We just learned the theory. The theory learn. When premium method is followed, old goodwill will be written off to the partners in which ratio? Old ratio. When premium method is followed, old goodwill will be written off to the partners in which ratio? Check the old balance sheet, old goodwill. Ranu's capital account debtor, Millie's capital account debtor to goodwill, write off the goodwill in old ratio. Old ratio also 2 is to 1. What is the old goodwill in the balance sheet? Write off this. So this into 2 by 3. Since the new partner brings in cash for goodwill, old goodwill is written off to old partners. Old goodwill is written off to whom? Old partners. Before we go for revaluation account, joint life policy, which value matters here? Policy value or surrender value? Surrender value matters. What is the surrender value given in the question? 12,000. The surrender value will be enjoyed by which partner? Old partner, because investment is made by old partners. It will be transferred to old partners in old ratio. What is entry we'll pass? Joint life policy account debtor to which capital? To Ranu's capital and Millie's capital in old ratio. So that 12,000 will be transferred to old partners in old ratio. Because it is an investment made by the firm, any benefit from the firm assets will go to the partners, that is old partners in old ratio. It's a very good question. Unless a student has tried this in the class, it's very or at home, it's very difficult to answer it directly in the exam. Right? So first, the new partner brings in money for goodwill, share it in sacrificing ratio. You cannot get a double benefit, so old goodwill in the old balance sheet is written off. Joint life policy surrender value transfer to what? Old partners in old ratio, which is not important for us here. What should we ignore? Ignore policy value. What is the policy value given? Why? This you will get it only when a partner dies. Ignore the policy value 75,000. Why that is given? Just to confuse you. Because sometimes students may make adjustment based on 75,000. At the time of admission or retirement of a partner, you will get only which value? Surrender value. Now, go for step 3. What is step 3? Revaluation account. Of course, it is as usual. You will debit which one? Losses. What is a loss? What is a loss? Reduction in asset or increase in liability is a loss. What is a gain? Increase in assets or decrease in liability is a gain for us. Try to prepare revaluation account in this case. Try. Okay. How point number C will be adjusted in revaluation? How to adjust point number C in revaluation? Ronwan Millie has purchased a machine on hire purchase system for how much? 15,000. Only how much to be paid? 500 to be paid. 500 to be paid. Wait. Both machinery and liability is not recorded in the balance sheet. In the asset side, that is not recorded. Liability side is also not recorded. Now we are going to bring an asset. Bringing an asset into balance sheet, into the firm, is it a gain or loss? Gain. So record by machinery account. No need to wait, record. By machinery account. How much? How much unrecorded machine? 15,000. Machine is 15,000. Loss is that liability for the machine. Liability for machine. Please do it along with me. No, wait. 500. Bringing an asset is a gain. Recording liability is a loss. Then, what is the next one? Joint life policy already adjusted. Look at point number E. What is it? What do you mean by accrued income? Incomes earned but not received. Incomes earned but not received. Is it an asset or liability? Asset. Anything receivable is an asset. Again, bringing an asset is a gain for us. By accrued income. By accrued incomes, how much to bring? 500. Accrued income, 500. Bringing an asset or recording an unrecorded asset is a gain for us. Then, market value of investments எவ்வளவு கொடுத்திருக்காங்க? 23,900. Wait பண்ணுங்க. Look at the investment account in the balance sheet. 20. What is the market value? 23,000. So immediately what you have thought is, okay, reduction. Reduction how much? 1,100. 1,100 reduction. On the reduction எடுத்து to which account போடுவோம்? Investment account போடுறோம். No, wait. We maintain an investment provision. We maintain an investment provision on the liability side. Why that investment provision is maintained? Why that investment provision is maintained? To adjust for losses if any. What is the investment provision given in the balance sheet? 2,000. There this reduction will be adjusted. There this reduction will be adjusted. So what is the surplus after this? That will be brought to revaluation account as by investment provision. So revenue crediting, we have got a surplus provision. We have got a surplus provision. That surplus provision is a gain for us. That we will bring it in revaluation account. Once again, pay attention. Suppose in investment provision இல்லைன்னு என்ன பண்ணிருப்பீங்க? To loss in investment, reduction in investment, you would have charged how much? 1,100. Since there is an investment provision, 2,000 rupees we maintained, but loss is only 1,100. Surplus provision is a gain for us. Any surplus provision created is a gain for us. That's why I said, unless the student has tried this in the classroom or at home, suddenly in the examination you will not think much. Just reduction you would have posted 1,100 like that. Okay, next. See, to make you comfortable, I can solve you easy questions in the class, but examination kaparama, you will feel that they are tough. Coming back, next adjustment. What is the next adjustment? Shika, an old customer, promises to pay some money. பழைய customer வந்து promise பண்ணானா, is it a gain or loss? Past year, one customer purchased goods, we have written off as bad. We have written off as which one? Bad debts. That customer comes and says, I will pay the money now. It's a gain or loss? Gain. By, don't put old customer's account. By bad debts recoverable. How much bad debts recoverable? That is old customer. Bad debts recoverable. Is it recovered or recoverable? Promise to pay. Paisa pay panla. Promise to pay. Bad debts recoverable becomes what? a gain for us. Then, which adjustment next? Claim on account of compensation estimated at 750. Oh, claim, last na putrading. Look at the liability side. Is any workman compensation? Yes. Look at the workman compensation. How much is there? 6,000, but claim is only 750. Look at the liability side, please. Workman compensation 6,000. We create a provision. We are maintaining a provision, liability. But liability is only 750. Now, is it a gain or loss? Gain for us by workman compensation. 6,000 we created, but liability is only 750. Now, balance is a gain for us. Excess provision or surplus in provision is a gain for us. 5,250. Then, what is the next one? Provision for bad debts. How much? 3,000. So, immediately, provision for bad debts. We will take how much? 3,000. No. Check the old balance sheet, please. Check the old balance sheet, please. Already we are maintaining a provision of, already we are creating and maintaining a provision of 2,500. Now what is the provision? 3,000. Now we have to create extra 500 to provision for bad debts. That extra provision, 3,000 left. Already we maintain 2,500. The additional provision is a loss for us. Any other adjustment? Once again, machinery brought on or brought in books, liability for the machinery is a loss. Machine to be recorded in books is a gain. Liability for that machine is a loss. Accrued income not recorded to be recorded now, asset. It is an asset. Bringing an asset into the balance sheet is a gain for us. Investment provision, we have got a surplus. After adjusting the loss, we have got a surplus. That surplus is a gain for us. We record it here. Bad debts recoverable. Old customer coming and promising money is a gain for us. Workman compensation only 750, but we maintain 6,000. 5,250 is a gain for us. Provision for bad debts. Already we are maintaining 2,500. We require only 3,000. Now extra 500 provision is a loss for us. Tally this, you will get the net amount. How much? 22,400 is the profit. That profit will be transferred to Ranu and which one? Millie. In which ratio? Old ratio. What is old ratio? 2/3, 1/3 ratio. So this 22,400 transferred to old partners in old ratio. How much you will transfer? 22,400 into 2/3. This into 1/3. Anything that we missed out? Check any item that we missed out. Accrued income, market value of investment, old customer promising to pay, claim for compensation, provision for bad debts, everything recorded. So profit is shared in which ratio? 2:1 ratio. 2:1 ratio. Step 3 is over. Now start which account? Capital account of partners. Step 4, capital account of partners, particulars and 3 columns each side. Ranu, Millie, and what? Manisha. Start. By balance brought down. What is the opening capital of Ranu and Mili? 30,000. By balance brought down, old balance sheet amount. Listen. I request you to listen for next 2 minutes, then you can copy it, pay attention. What is the journal entry we passed for goodwill? Cash account data to Manisha's capital. How this will be posted in capital account? Cash account led to Manisha's capital. Manisha's capital, how this will come as? By cash. By cash account for goodwill, how much brought in? 12,000. Look at the next entry. What is the next entry we passed? Manisha's capital account data to Ranu's capital and Milli's capital. How this will be posted? Manisha's capital should be debited. Debit means left hand side you have to post how much? 12,000. Ranu and Milli's capital should be credited with how much? 8,000, 4,000. Now pay attention. It will come as to Ranu and Milli. Which capital should be debited? Manisha's capital should be debited. It's like a contra entry madri. By Manisha's capital, which has to be credited? Ranu and Milli has to be credited. Once again, I repeat for this, pay attention. Journal entry is Manisha's capital account data to Ranu's and Milli's capital. Then in the Ranu and Milli's capital, it will be credited. 8,000 and what? 4,000. Wait. One more thing. This 12,000 rupees, did she bring for goodwill or capital? Manisha brought 12,000 for capital. It will not stay in your capital account. This 12,000 rupees you bring, that will be transferred to whom? Other partners' capital. You are paying this not as a capital. You are bringing this as which one? Goodwill. So that's 12,000 rupees brought in, goes to other partners' capital. Okay. Then by cash brought in for goodwill. Over. Okay. Cash brought in for capital. What is the capital amount? Only that 50,000 will stay in your capital account. 12,000 you bring for goodwill, that goes to other partners. The capital brought in by the partner only will stay in your capital account as closing balance. Later on when we put to balance carry down, Manisha will show a balance of only how much? 50,000. Because cash brought in for capital will stay. Cash brought in for goodwill will be transferred to what? Other partners. Next, one more entry pass pannirukku. Goodwill ke one more entry pass pannirukku. Any entry? Ranu's capital account data, Milli's capital account data to goodwill account. Old goodwill written off. How this will come? To goodwill. That old goodwill written off. Old goodwill written off. How much? 3,000? 320? 1,660. Old goodwill written off to old partners. Then, joint life policy entry pass pannirukku. Joint life policy account data to which account? Ranu's capital and which capital? Milli's capital. How this will come? By joint life policy. Which value? Surrender value. Only for Ranu and Milli, 8,000 and what? 4,000. Then, revaluation profit. Just now we worked out. Revaluation profit. How much? 14,933. 7,467. 7,467. Then Checking the old balance sheet, do you find any general reserve P&L account? Yes, there is a general reserve. This general reserve should be transferred to whom? Old partners in old ratio. By general reserve. By general reserve in old ratio. What is old ratio? 2 is to 1. 7,000, 3,500. 2 is to 1 ratio you transfer. Then anything else? Any losses like advertisement suspense? Any losses like advertisement suspense? Miscellaneous expenditure to be written off? Nothing else. Tally this, you will get to balance carry down for others. Take it up now. You can take it up now. I repeat, by balance brought down 30,000 and 24,500. Cash brought in for goodwill 12,000, that is transferred to the others. This is a goodwill adjustment, 12,000 transferred to the other partners. Cash brought in for capital will stay in the capital account. Joint life policy, surrender value recorded only for old partners. Revaluation profit also transferred to old partners. General reserve transferred to old partners. In the question, there is no P&L account, there is no other reserve, other losses. And old goodwill written off also amongst which partners? Old partners in old ratio. Workman compensation fund, the balancing adjustment to me. Workman compensation fund, 6,000 less 750 is a liability. Remaining amount was transferred to which account? Revaluation account already. Already the revaluation profit will include the surplus workman compensation. Wherever there is a liability against a reserve, we adjust in which account? Revaluation account. Out of 6,000, 750 liability, 5250 already we adjusted in which account? Revaluation account. Try to prepare balance sheet after admission of the partner. Please prepare the balance sheet after the admission of a partner. Yes, pay attention. This one, cash brought in for goodwill. What is the first journal entry we passed? Cash account data to goodwill. Second journal entry paranga. Manisha's capital account data means debit Manisha's capital 12,000. To Ranu and Millie will be credited with how much? 8,000, 4,000. Otherwise, this goodwill 12,000 removed from Manisha's capital and adjusted in which one? Ranu and Millie's capital 8,000, 4,000. Like a contra entry Mari. Check the entry we passed. Cash account data to Manisha's capital first. Then Manisha's capital 12,000 to the other two partners 8,000 and what? 4,000. Then old goodwill written off for Ranu and Millie. Ranu and Millie's capital account data to goodwill account. Then cash brought in for capital only will stay as your capital. இங்க capital cash எது கொண்டு வந்தீங்களோ or cash எதுக்கு capital கொண்டு வந்தீங்களோ அதான் closing balance இருக்கும். Joint life policy surrender value, revaluation profit, general reserve transfer to old partners. Now let us prepare the balance sheet. What and all will come in the liability side? Creditors, there is no change. Check the old balance sheet also. Creditors எவ்வளவு இருக்காங்க? 7,000, that will continue. Then, what about other things? Investment provision already adjusted against investment. General reserve transfer to old partners. Workman compensation fund, will 6,000 will come. Now what is the liability? Workman compensation liability. No, 750. Liability is only 750. 5,250 already adjusted. Workman compensation 6,000 minus 750, 5,250 surplus adjust பண்ணியாச்சு. How much will continue in the balance sheet? 750 will continue in the balance sheet. Any other liability? Any other liability? Before capital, any other liability? Check. Investment provision, investmently adjust பண்ணிக்கலாம். Provision for bad debts will be adjusted against debtors. Yes. Liability for mission. That unpaid amount that we bring. The revaluation account record பண்ணிருக்கோம். How much? 500. Amount payable for mission 500. Then machinery will come in the asset side. Capital account of partners. Who are the capital account? Ranu, Millie and what? Manisha. 64,613, 41,807, 50,000. Total amount will come. 1,56,420. Asset side, let us maintain the same order of balance sheet. Whether goodwill will come? Goodwill 4,980, written off already, it will not come. Then investments, the new value, revised value. What is the revised value? 23,900 will come as given in the question. Then stock, is there any change in stock? No change in stock, 15,000. Stock, there is no change, 15,000. Then debtors, what is the gross amount earlier? 20,000 minus what is the provision required? 3,000, 17,000. Debtors 20,000 minus 3,000, how much? 17,000. Then bills receivable, there is no change. Bills receivable, there is no change. Same amount. How much? 12,500. Then bad debts recoverable. That Shika account. Old customer promised to pay. 1,750 old customer promised to pay. Then accrued incomes. Accrued incomes to be brought in books, how much? 500. Then joint life policy. Journal entry pass பண்ணிருக்கோம். Joint life policy. Surrender value. How much? 12,000. Joint life policy surrender value how much? 12,000. All these are given in adjustment, not in old balance sheet. All these amounts are available from the adjustments. Even machinery also. Machinery, that on the hire purchase machinery to be recorded how much? 15,000. Even this is given in the adjustment. Then bank balance, already what is the old balance available? 5,020 plus எவ்வளோ capital கொண்டு வந்திருக்காங்க? Plus goodwill premium method, cash for goodwill, how much is brought in? 12,000. Add up, you will get 5020 plus 50,000 plus 12,000 for goodwill. Italics. It's definitely a very good question for 15 marks in the exam. What and all we learned extra in this question? Number one, sacrificing ratio. New ratio minus, that is old ratio minus new ratio. Sacrificing ratio. Second, goodwill. Goodwill is adjusted through which method? Premium method. Cash is brought in, that is transferred to old partners in which ratio? Old ratio. And old goodwill is written off. Old goodwill is written off, that will not appear in the balance sheet. Then joint life policy surrender value we recorded. Joint life policy account debtor to old partners capital account, like that. That surrender value got recorded. What is the next one we learned? Revaluation. Revaluation. New adjustments we learned. Bringing an unrecorded asset like bad debts, accrued income, machinery under hire purchase. Then liability for mission. Liability for mission, that is given in the adjustment. With all these information, we prepare what? Balance sheet. Yes. I repeat balance sheet explanation. Please remember. Investment revised value. How much? 23,900. Stock, there is no change. Debtors, 20,000. Already 2,500 we have got provision, but new provision required is how much? 3,000. So extra 500. So 17,000. Bills receivable, no adjustment. When a customer promised to pay the money whose account was written off as bad, that is a gain for us. It is also an asset for us. Bad debts recoverable. Anything that causes inflow is an asset for us. Accrued income, income receivable is an asset for us. Joint life policy is an asset. Machinery under hire purchase, yet to be recorded. Record it now, asset for us. Then bank balance depends on capital and goodwill contribution. Then what is the next one? Creditors, workman compensation, whatever is the liability you recorded now. Surplus already we adjusted. Liability for machinery, unpaid amount alone comes, then capital account of the partners come. Workman compensation liability is only 750 because the surplus has been already recorded. Listen, pay attention. In this question, we prepared which account? A revaluation account we prepared. Listen, don't copy this. Wait. Which account we prepared? What is the impact of revaluation account? Impact of revaluation account is in the balance sheet, what happens? Value of assets and liabilities changes or remains the same? Changes. For example, machinery value brought in, clear. Accrued incomes brought in, okay. Investment adjusted, clear. Bad debts recoverable, we bring it in the assets like that, clear. Because of the revaluation account, what happens is the value of assets and liabilities change. But wait, pay attention. It's the most important thing. Listen to it. 1 minute it will take for you to listen and understand. A and B are partners. Who are the partners? They admitted C into partnership. There is a revaluation of assets like this. But after the admission, A, B, C, they want to continue with old assets and liabilities value. There is a revaluation. There is a alteration in the assets and liability value. But new partners, A, B, C, want to continue with old asset and liability value. What to do? Do you understand the situation? Because of admission of partner, at the time of admission of partner, assets and liability value will change or will not change? Will change. Yes, sir. A, B are there. They admitted C into partnership. Value of assets and liabilities changed. But after the admission of partner, they want to continue with old assets and liabilities value. Adhe balance sheet values they want to continue. What to do? They will prepare an account called as memorandum revaluation account. They will prepare an account called as which account? Memorandum revaluation account. Sir, what is a memorandum revaluation account? Simple. Memorandum revaluation account, wherever there is a word memorandum, it is a rough work. We'll do the rough work and throw it. Andha madri. Memorandum revaluation account, how to prepare this, sir? Wait. In step 3, we prepare which account? Revaluation account, where we record which one? Increase in assets, decrease in liability, which is a gain. Decrease in assets and increase in liabilities we record, which is a loss. We transfer the profit to which ratio? Old partners in which ratio? Old ratio. Now, in the question, if they tell that assets and liabilities, which account we are going to learn now? Memorandum revaluation account. When it will be followed? If partners decide not to alter the value of assets and liabilities, we are going to prepare which account? Memorandum revaluation account. Title will change. Which account? Memorandum revaluation account. Listen, it will have two parts. First part is same. What do you mean by first part is same? Record the increase in assets, decrease in liability. Record the decrease in assets and increase in liability. Profit will be transferred to old partners in which ratio? Old ratio. The second part, whatever we have done in the first part, we will cancel it. Whatever we have done in the first part, we will cancel it. Second part, enna பண்ணுவீங்க? To increase in which one? Assets. To decrease in which one? Liability. Then credit side by decrease in எதுக்கு சார் இந்த மாதிரி பண்ணுமா? வெயிட் பண்ணு. By increase in which one? Then in this one it will come, what will come? Loss will be transferred to all partners in new ratio. All partners will share this loss in which ratio? New ratio. This is same like goodwill now. We raise the goodwill in which ratio? Old ratio. Write off the goodwill in which ratio? New ratio. Same way, we adjust the value of assets and liabilities in old ratio. If the partners want to continue in the same old asset values, then write off. What do you mean by write off? Whatever you have done in the first one, cancel in the second one. But the loss will be transferred to all partners in what? New ratio. Otherwise, the first part happens before admission of a partner. Second part happens what? After the admission of partner. Clear? Start. Theory. Are they getting? Memorandum revaluation account. Memorandum revaluation account. Please write the theory. Memorandum revaluation account. Memorandum revaluation account. Below that, it is followed. It is followed when partners decide. It is followed when partners decide not to alter the value of assets and liabilities. When partners decide not to alter the value of which one? Assets and liabilities. When partners decide not to alter the value of assets and liabilities. No need to copy this, please. Please don't copy this. This is for your understanding. I have typed here. We can just write 2 sentences. Start. Part 1. Part 1. What is part 1 in the memorandum revaluation account? Prepare normal which account? Revaluation account. Transfer the profit or loss. Take it up. Transfer profit or loss in which ratio? Old ratio. Part 2. What is part 2? Reverse of part 1. Reverse of which one? Part 1. Whatever you have done in part 1, cancel in part 2. Transfer the loss. Loss in part 2 in which ratio? New ratio. Okay, maybe first profit and the second one loss. So it is like raising the goodwill in old ratio, writing off in new ratio. Part 1, prepare normal revaluation account. Prepare normal revaluation account. Transfer the profit in which ratio? Old ratio. Part 2 is nothing but what? Reverse of part 2. Transfer the loss in which ratio? New ratio. No need to copy this format or whatever. We know how to prepare revaluation account. Transfer the profit in old ratio. Part 1, whatever you have done, reverse it in part 2. Transfer the loss in which ratio? New ratio. We'll do a question or we'll do a problem and we'll stop with this for the day. Go to question number 3. It will take around 15 minutes, 20 minutes of time only. Go to question number 3. Example in the mari title lam kuduthirukka maatanga. Okay. From the problem you have to understand, is it memorandum or not? Go to that. B and S are partners sharing profits and losses in which ratio? In the proportion of their capital. Look at the capital. What is the capital? 20,000, 15,000. 20,000, 15,000 in a ratio. 4:3. Please note the capital ratio is what? 4:3. Then general reserve creditors are given. Various assets are given. Adjustments parangalam. P, the new partner will bring how much? 10,000 as capital. 10,000 as capital. And how much? 3,000 for goodwill, as she will be sharing 1/4 of profits. So the new partner brings in cash for goodwill. New partner brings in cash for goodwill. Which method? Premium method. Premium method. New partner brings in cash for goodwill. Premium method. Point number 2 paranga. Provision 2% for debtors. Stock to be reduced by 5%. Premises to be revalued by 12,650. Machinery revalued. Furniture revalued. Office equipment revalued. So adjustment number 2 talks about which one? Revaluation. Point number 3 paranga. Point number 3. What is given? Partners agreed that values of assets and liabilities should remain unaltered. Because of this sentence, we are going to prepare which account? Memorandum revaluation account. All others are same. Goodwill, new ratio, old ratio, capital account, balance sheet, everything is same. Only thing is that revaluation account will have 2 parts. Normal revaluation and reverse of revaluation, like that. Okay. So it's compared to the last problem, it is a simple question. Only one extra concept. They do not want to alter the value of assets and which one? Liabilities. Start. This is question number 3. Start. Please do it along with me. Let us be fast. After learning 2 or 3 problems in step 1, அதே time இது எடுத்துக்கூடாது. You should not take 10 minutes of time. Probably 1 or 2 minutes you should finish. Start. New ratio and which ratio? Sacrificing ratio we want in this question because premium, goodwill method, premium. Who are the old partners? B and S. What is the old ratio? We see capital ratio is which one? 4:3. B and S. Okay. B and S capital ratio 4:3. Otherwise it is like 4/7:3/7. 4/7, 3/7 old ratio. Now P is admitted for 1/4 share. So it should be approached same like the last question that we have done. If the new partner shares 1/4, what about the remaining? Balance profit will be 3/4. Balance profit will be 3/4. This 3/4 will be shared by B and S in their ratio. 3/4 into 4/7. 3/4 into 4/7 will become 12/28. Then the other partner 3/4 into 3/7. Our ratio element. This will give us 9/28. Do it along with me, no need to wait. For P, 1/4 can be written as 7 times earlier. So it will be 7/28. So this is a new ratio. 12:9:7. New ratio. We want sacrificing ratio. Same like the last question. How to work out? Old ratio minus old ratio. B and S. What is the old ratio? 4/7 minus what is the new ratio? New ratio 12/28. Old ratio minus new ratio. LCM எடுத்தா எவ்வளவு times வரும்? 4 times. So this is 28, okay. 4 times 16 minus 12. 16 minus 12/28, it will become what? 4/28. The answer will be 4/28. Then for S, old ratio was 3/7 minus 9/28. So 12 minus 9/28. 12 minus 9/28. What is the ratio? 3/28. So P is sacrifice, S is sacrifice. You can always check. Sacrifice will be always equal to gain. Add பண்ணி பாருங்க. 4/28, 3/28. New partner will get what? 7/28. Sacrifice done by the old partner will be equal to the new ratio. 4/28, 3/28. The new partner gains what? 7/28. Step 1 done. What is the next one? Step 2, adjustment for goodwill. Which method? Premium method. Premium method. Because new partner brings in money for goodwill. What is entry for bringing in money? Cash account debtor to peace capital account. How much he brings in? 3,500. And this will be shared by the partners. Peace capital account debtor 3,500 to peace capital to B's capital, peace capital. Yes, capital. In sacrificing ratio 4:3. Sacrificing ratio also 4:3 in this question. And most important, check in the old balance sheet. Is there any old goodwill in the old balance sheet? Balance sheet, let's check pannunga. That old goodwill irka. If there is any old goodwill, you would write off. Till this, same like last question, right? We worked out sacrificing ratio. New partner brings in cash. So cash account debtor to capital. Then that new partner's capital to old partner's capital in which ratio? Sacrificing ratio. In this question, any joint life policy given? No joint life policy also. No joint life policy also. Step 3. Which account? Memorandum revaluation. First prepare part 1, normal revaluation account. Then part 2, reverse the revaluation. Part 1 la profit vanda, of course, part 2 la loss one. This is based on the adjustment number 2. To provision for bad debts. Evlo percentage sollirka? 2%. How much? To provision for bad debts, 2%. How much? 2% of the debtors balance. 17,500 into 2%. Do it along with me, no need to wait. 350 then. What is the next one given? Stock to be reduced by 5%. Stock to be reduced by 5%. What is the stock value? 14,100 into 5%. 705 then. Premises to be revalued by premises. 12,650 is the new value minus what is the old value given? Premises order value parang 10,000. So increase 2650 by premises 2650 then. What is the next one? Machinery parang old value 2,800 new value, old value 3,500 upper loss. How much? 700 loss. 2,800 new value, old value 3,500 and 700 rupees loss. Then furniture 1540 loss or gain. New value 1540. What is the old value? Loss. 210 loss. Then office equipments. Office equipments. What is the new value? 495. What is the old value? 550. What is the loss? 55. Tally this. In this part, there may be a profit. This profit will be transferred to whom? Old partners. For the old partners, B's capital, S's capital in old ratio. Take it up along with me, no need to wait. What is old ratio? 4:3. The 2020 way 4:3 ratio la split பண்ணுங்க. Sorry. Balancing figure வரும். This will be transferred in 4:3 ratio. 630 into 4 by 7. 630 into 3 by 7. 360, 270. This is part 1. இங்க டெபிட் பண்ணதெல்லாம் நெக்ஸ்ட் என்ன பண்ணணும்? அப்படியே கிரெடிட் பண்ணுங்க. 2க்கு பதிலாக இங்க பை அவ்வளவுதான். We cancel that revaluation, that's all. Then whatever you debited, credited here, you debit. Then second part, profit will or loss will come. Second part will have a loss. By loss, it will be transferred to whom? B, S, P. Loss also will be 630. Tally பண்ணிருக்கலாம். Loss will be 630. Transfer in new ratio. What is the new ratio? 12:9:7. 12 by 98, 9 by 9, sorry, 12 by 28, 9 by 28, 7 by 28. In that ratio, you can adjust it. Next, which account you have to prepare? Start. You are going to prepare capital account next. That is, as usual, you can prepare capital account. Start with capital account next. By balance brought down. What is the opening balance of B and S? 20,000, 15,000. Then, by cash brought in for goodwill, same like last question. What is the cash brought in for goodwill? 3,500. Same adjustment to B and S's capital. That goodwill adjustment will come in P's column. 3,500, that is transferred by P's capital. Hello, transfer pannu goodwill. Sacrificing ratio 2,000 and what? 1,500 transferred. Then, any JLP in this question? Any joint life policy? No joint life policy, no goodwill written off, nothing. By cash brought in for capital. Cash brought in for capital how much? 10,000. 10,000 then. By revaluation, let us finish. Revaluation account profit. What is revaluation account profit? We transferred in the 360, 270. 360, 270 then to memorandum revaluation account. How much? 270, 202.5, 157.5. That is written off. Then by general reserve will be transferred to old partners in old ratio. What is old ratio? 4:3. General reserve transfer to old partners in old ratio. 4:3 la transfer panna. How much? 1,200, 900. Check in the old balance sheet. Any P&L account, any losses to be adjusted. Any advertisement suspense, P&L account, any losses? No. That's a two balance carry down. Two balance carry down. Then prepare the balance sheet. See, balance sheet or assets எதுவுமே மாறாது, அப்படியே போடலாம். Premises, machinery, furniture, equipment, stock, debtors, cash, bank. Cash and bank only will change. All other assets same value. Tell me the values பார்க்கலாம். Premises how much? 10,000. Then machinery old value how much? 3,000. Then which asset next? Everything old value. What is old value? 1,750. Then Equipments, how much? 550. Yeah. Then stock old value, how much? 14,100. Then bills receivable also old value. What is old value? 3,060. All assets will appear at the old book value. All assets will appear at the old book value. Only the cash and bank balance will change. Bank balance, how much is there? Bank balance, how much? 1590. Cash balance will change. What is the cash balance? 50 plus capital. Capital, how much is brought in? 10,000 plus goodwill. 3,500. So total 13,550. All other assets continue at old value. Debtors also old value. 17,000. All old values. Pay attention. Liability side, creditors will come in the old value. What is the creditors balance? 15,000. I request you to listen for a minute, then you can take it up. General reserve is transferred to partners. That will not come. Then closing capital balance will come. Capital account of which partner? BSP. As per this closing balance. What is the balance? 23,290, 17,468, and this one will come. Total this 65,600. So when the partners decide not to alter the value of assets and liabilities, they go for which method? Memorandum revaluation method. What is memorandum revaluation? Part 2, you do the normal account. Part 2, you cancel whatever we have done in part 1. Transfer the loss in new ratio. Transfer the loss in new ratio. Capital account is as usual. Then we prepare balance sheet after admission. Pay attention. 2 minutes. Then you can copy. Pay attention. What we have done so far is, admission of partner level. What is the step 1? New ratio, old ratio, and what? Sacrificing ratio. What? Number 2? Goodwill. Either revaluation account or premium method. We followed premium method. Then prepare revaluation account. Memorandum revaluation when they do not want to alter which one? Assets and liabilities. Then we prepare the capital account and balance sheet. Pay attention. Now, the next class what we are going to see. Is number 1. The capital will not be in profit sharing ratio. In this problem, this capital will not be in which ratio? But partners would like to keep it in profit sharing ratio. What to do? Okay. Number 2, goodwill will not be given in the question. Hidden goodwill. You have to find out the goodwill based on the information given. And sometimes, wait. New partners capital itself will not be given. The last 3 questions, what is given? New partner brings in this much for capital like that. It is given. In some question we are going to see, based on old partner capital, you have to work out new partner capital. Based on old partner capital, you have to work out new partner capital. Those problems you are going to see. But how many steps totally? 5 steps. Retirement also 5 steps only. Clear. New ratio, goodwill adjustment, revaluation, capital account, and which one? Balance sheet. That 5-step process will continue, admission, retirement, and all.